Thanks, David. And Kyle, I'll start with one of my first of many charts. I suppose the big issues I wanted to get across today were mainly about the outlook for this year in an economic sense, but also just do a quick reflection on some issues that are very important for Australia and why we're still regarded so highly from an overseas investor's point of view. And that's something we should try and maintain, actually, because Australia still has only an extremely small population and we have these huge investment needs. And it was interesting when David here was talking about the dollar-wise, 24 billion in assets, if I remember that number, that's colossal. And what's Australia's population? Roughly 24 million. So this is an important part of Australia, and you can understand trying to maintain that asset base really needs a careful consideration of how we trade with our trading partners, but also how we also need the money from overseas to maintain the quality of life we have. Just quickly, I wanted to kind of go through, from an overseas perspective, the big thing that impresses people is that we've had 24 years of continuous growth in Australia. And I've got a GDP chart up here, which is just basically measuring output in the economy. And when the September quarter numbers came out, they showed a very large negative. And I got to say, thanks Queensland for that, because it was that very poor weather conditions through July, August and September that rolled down the east coast of Australia from Queensland into New South Wales. It did also affect, of course, parts of Victoria. But we believe that's one of the big reasons why we had that weak September quarter GDP number. And it just fits in with, we think, what is still a very, very strong story from an overseas investor's point of view about Australia. We've had 24 years of consecutive annual growth. We expect when the December quarter numbers come out next Wednesday that it will be 25. So we will beat the Netherlands. How about that, right? So they're the ones that had the record before. So we think the December quarter numbers will be around 1%, most probably, in annual growth, pretty much in the low twos, and we suspect the ABS is going to fiddle with history like they usually do. So when you look at these charts, over those 96 quarters, we've had 3 negative ones. So it's not the end of the world, right? But the media tends to like nice stories like recessions and stuff. So they went overboard and the usual doubters came out. And they're always good to fun to grapple with, because I deal with a lot of them every day where I work. It's unbelievable the amount of people that keep telling me Sydney house prices are about to collapse, or Melbourne house prices. It's done amazing. So just bear that in mind when you're talking with people overseas, that we've still got a very strong track record of continuous growth. And I've got to say, it's part of it is definitely good management, and some of it is good luck in terms of our resource base and the quality, I suppose, of the economic reforms that up until the last few years that have been done by successive state and federal governments to try and make our economy a lot more efficient. Though, as David was pointing out, with the energy sector at the moment, there's some fairly big challenges. One of the issues I suppose I wanted to also underscore here was this recent history of Australia with commodity prices and also investment, mining investment. Has had a profound impact on our economy. Both these charts are very long term. They go back to the 1880s. But the first thing was to demonstrate the amount of income the rest of the world was prepared to pay us, particularly our new investors or our new major trading partner, which is China, because of the resources we've got. So we had an enormous increase in commodity prices. It gave the kind of income levels and income certainty for a lot of these groups to commit to extraordinary amounts of mining investment, and that's what we've seen from that period of about 2006 to its peak in about 2012, and that was quite extraordinary because we went through the GFC. Australia escaped the GFC without the significant problems that a lot of our trading partners did. And that's what the chart on the right's about. We're now adjusting to this period of a fairly significant decline in mining investment and also to a period of much lower commodity prices. But the headwinds have kind of changed on this slightly lately, so the commodity prices have started to pick up again, and that's due to a couple of issues. I suppose the big thing is that Australia is still able to provide very high quality resources across the energy sector, particularly coking and steaming coal, and increasingly from Gladstone LNG gas. And we can deliver it. And the big issue with a lot of commodity producers and exporters is that they don't have this reliability of supply that we can deliver of high quality product. Now, China's done something interesting from the middle of last year. They stimulated their domestic economy again. So the building industry is picking up. But importantly, they've decided to make big structural changes to their economy. So they closed a lot of the mines that produce the poor quality thermal and coking coal, and they're closing a lot of the highly polluting steel producing smelters. So what we have now is a very big shift in demand again, in a positive way for us. It's driven commodity prices up again, and that's what's on the left-hand chart. So it's kind of solved a lot of problems in a way for the state and federal governments, because suddenly we're getting a big income boost from offshore. And that's demonstrated by that peculiar wobbly chart on the right there, which is the monthly trade balance, gone from deficits of 3 to 4 billion to surpluses of 3 to 4 billion. Who'd ever thought? Just with this shift in commodity prices, because all that mining investment has resulted in an enormous increase in the volumes of exports on the mining side. So that's mainly around the coals, of course, and iron ore, but also a lot of the other metals. So we've got these big volumes. They faced a period of poor prices up until about the September quarter last year, but now prices are up. And most probably the way we look at it, maybe the markets don't yet, we think iron ore most probably and steaming and thermal coal prices will average out to be twice as high in this calendar year as what they were in last year. So it doesn't look like China's going to pull back on some of these changes. And we now have, I'll be kind, a new president in the US who's determined to lift US growth by reviving their industrial sector. And for a provider of industrial commodities in a big way, which is Australia, that can only be positive. So there is kind of a good news story happening in Australia with this income shift. And you can see it here when you look at the mining vacancies in particular. We track the data very closely, and it's quite clear. Also, I should add, you should take a big interest in those trade numbers, because your superannuation is invested in some of the biggest mining exporters that the world has ever seen, and that's BHP, Rio, and most probably you've got a bit of Fortescue in there even though you didn't know about it. And their profit results have been just darn extraordinary. And they will, as a result, invest a little bit more, particularly on the maintenance side, to make sure their mines are running flat out. And some of the groups are even going to open some of these mothball coal mines, and that's what we've seen lately. So it's a very positive story for Queensland. It's a very positive story for your superannuation, because the share market looks like it's going to keep going up. It's a very positive story for the state government, because they'll have more royalties. And I shouldn't leave the paupers in Canberra out of this either. The federal government likes to pretend it's got a lot less money than it has. We think the commodity shift here is going to add about $5 to $6 billion to their pockets. So the best thing you can do is to live in a marginal seat and scream, because you'll get more cash, okay? And it was interesting during the election campaign, you did end up with the promise of a new football stadium, and I gather that they'll start building that, or the building works will start soon. And of course there was that issue around the railway line. So the next series of charts here are really about the mining side. All the investment we think will add about 2% to overall GDP growth in the economy over the next couple of years, and the numbers are quite big, of course. People get very pessimistic about mining investment in the future because they think the companies are very strapped for cash. I'd suggest you go and have a look at the analysts' reports on both Rio and BHP. You'll notice they both lifted their dividend quite strongly, and Fortescue. I think the big problem for these groups now is if prices stay a lot higher than they thought, what they're going to do with the cash. So they lifted dividends, but the problem for them always is they have to keep finding new resources. So there will be new investments in Australia on the mining side in the next 5 years, particularly if prices stay up. The weather is the big issue. I mentioned it before. That's the weather patterns from those Bureau of Meteorology sites, if you want to have a look at it. And the blue bits just signify extraordinarily high levels of rainfall. So I tend to concentrate a lot on the mining stuff. But of course, the rural sector is a huge influence on northern Queensland. And with all that rain, there's lots of grass. And for the extensive cropping people, it's just fantastic. And that's what we're seeing with the beef industry in particular. And I think we'll continue to see that through this year, because I notice you've had a lot of rain up here recently, a little bit more than usual. And it's got to be good for the size of the cattle, I imagine. And in a period when we think the Aussie dollar's headed back to 70 cents, I think the outlook for the beef industry is extraordinarily good. And that also means more incomes locally, which is great. This is just something on the outlook for the committed projects. This is more outside of the mining sector, and this is a survey that's put out by Deloitte's, because there are other aspects to the economy to be optimistic about, and we think, I suppose it's classified as non-residential construction, but that means basically on the commercial property and tourism-related facilities in particular. When you look at the approvals data, there's been a very significant increase. And it is fascinating to see the amount of new hotels that have been approved for construction, not only in Sydney, Melbourne and Brisbane, but also in some of the regional areas. Because the big shifter that we're seeing globally is a big swing towards higher levels of tourism. And I didn't request this guy to do the alts and ads out the back there, but the alts and ads are also in those numbers on the left there. So there's a huge amount of refurbishment coming up in the retail sectors for these large shopping centres, and that's another very big influence on the growth outlook, a favourable one, because the population growth in Australia has been very strong over a long period of time, and at this stage neither of the major parties is talking about lower immigration rates, though there is a red-headed lady that comes from Queensland, I think, that wants lower rates. But I think somebody needs to talk to her about these issues, because we need a high immigration program in Australia, because we have significant ageing problems coming, and a very large cohort in the population, like myself, is very close to kind of moving into pension phase, and we need a lot of people to replace the people in these current jobs. There's a couple of issues, though, that most probably need to be overcome a little bit if we're to kind of extract the biggest amount of growth from the economy that we can. In other words, if we're to get the economy growing at close to 3% GDP. I suppose the big one is that we need governments in particular to spend a lot more on capital works. And I'm sorry, but I've got to bring up this four-letter word called debt. Debt is nothing to fear, particularly if it's giving you a better lifestyle. And most probably everybody in this room lives in a comfortable house or a comfortable dwelling, so you're quite prepared to accept that you needed to borrow money, hopefully from Commonwealth Bank, to deliver that lifestyle. But with regards to federal and state governments, there's been a terrific amount of poison over a long period of time injected into the debate that debt is bad. But state governments in particular need to invest very large amounts of money to keep our infrastructure up. And they can't do that out of cash reserves or purely through asset sales. They have to do it out of borrowing long term. And we are in a period of exceedingly low interest rates, and I'll get on to that in a minute. So voters should accept that there is good and bad debt, and the good debt is the stuff that's associated with building you better transport facilities, which is road and rail and the occasional new airport, but also on the social side, which is around health and education facilities. We need a better educated population. Everybody wants first-class healthcare, and usually the state and federal governments have to provide it, and it requires debt. So we shouldn't be too afraid of debt. The peculiar chart on the right there is again from Deloitte's. This is about hurdle rates, because the business sector keeps saying they can't invest because they can't achieve the hurdle rate that they expect. And I suppose the problem that a lot of economists would point out to people is that hurdle rates should be a hell of a lot lower, because interest rates and inflation over the next 5 to 10 years look like they will remain exceedingly low. Even though they move up a little bit, we think interest rates will stay incredibly low. Now, I've just got to get on to something here that's a little bit more current, I suppose, because events in the US have arisen, and we've just had the start to the Chinese Lunar Year, and if the translation is right, it's the year of the rooster. And that's very important because China's our biggest trading partner and will remain so, our biggest trading partner, not only in terms of goods but also services over the next decade. But there's another big rooster that's running around in the US causing an enormous amount of dislocation, which is his kind of trademark, actually. He's a disruptor, always has been, always will be. Doesn't understand government, doesn't need to. So you can see the reaction by markets here. They're absolutely overjoyed with someone that's promising big growth and much lower company tax rates. And we're about to get a download on these new tax rates, I think next week, in the State of the Nation address in the US. So you should pay attention, because you've all got superannuation, as I understand it. You don't have a choice in Australia anymore. You have to give it to someone to manage, and strangely enough, they put 20 to 25% of it into US markets because they want exposure to the big global corporates, and that's where they are. So ever since the day Trump came in, US share market went up, longer term interest rates went up, and the US dollar went up. And we think that's going to keep on going, oops, all the way through this year, particularly if he delivers on changes to tax rates. And the company tax rate in the US could be 22% at the end of this year, not 35%. So no wonder the corporates are happy, no wonder the share markets are happy. Now, this chart was about long-term interest rates, and this is very long-term, right? So if you were around in Babylonian times, which is line up the left, I don't know where the Bank of England found this data, but they published it, so we feel obliged to use it. The hiccup in there in the 70s and 80s was high inflation, but we're back down again. So we are in a period of low inflation, And the Western economies are all ageing and they're mature. Okay, even the fastest growing economy in the world, large one, which is China, has a significant demographic problem coming in terms of ageing because of one-child policy. So, you know, growth can't be that great in the future for the world economy, and there's a surplus of savings, so interest rates will stay low. I've just got to turn to my last series of charts here. I've only got 3 more to go, on what's been going on with people feeling problematic about the future. Brexit, I suppose, was an example of that. This looks at income growth across all the different income groups from the lowest to the highest on the right over the last 10 years. And you can see it's a funny shape. So we got very kind of, you know, imaginative about this. Very hard to see an economist being imaginative, I know. We pretended it was an elephant. So basically, what we're saying is that this global problem with the middle income earners was that they went backward, which is what that chart was saying, compared to a lot of other income groups. So therefore, they're voting that way. So most probably the biggest message I should say, for the next couple of years is that people have to be very certain that they're not leaving anyone behind when they argue for big tax changes, which I think the current federal government wants, which is a big cut to the company income tax rate and most probably eventually a lift in the GST rate to 15%. Thanks for your time. I'll just leave it at that and pass it back to Kyle. Thank you.